Well, joining us this morning to discuss market strategy in the FOMC's meeting today is JPMorgan Funds Chief Market Strategist David Kelly. And David, good to have you back on the program. Of course, we got a little bit of a boost from those housing numbers earlier this morning, but everyone's watching what the Fed is going to say. Is there anything that the Fed could say today that could move the markets?
Well, I think the more they say, the less the markets will like it, actually. The economy does seem to be gradually getting through this soft patch. We're seeing a little bit of acceleration. But the problem is there's not very much the Fed can do. And if they announce any further quantitative easing, for example, that's only going to worry people that, is the Fed more worried about the economy than we thought? So at this stage, if they say very little, I think the market reaction will be good.
So then, David, are you saying that actually if there was to be QE2, quantitative easing again, that this could actually bring the markets down?
Yeah, I mean, I hate to make short-term predictions on the market, but the logic of it is this. Monetary easing at this stage isn't very effective. I mean, we've got the lowest mortgage rates that we've seen in really since Eisenhower, and yet we've got a housing market which is still extremely depressed. I mean, that housing starts number this morning, yes, it's a surge, but it's a surge to a level that's 200,000 units lower than the lowest number we'd seen in 50 years prior to this recession. It's still incredibly low. So it's not very effective at stimulating the economy. So if they say, the economy's sick and we're going to give it some more medicine, but people don't think the medicine's effective, that only hurts confidence.
David, it's John Erlichman. At the same time, the stock market's been on a bit of a roll recently. If you had $1,000 in your pocket and it had nowhere else to go, would you put it under your mattress? Would you buy an iPad? Or would you put it into the stock market?
Well, I have an iPad, so I'd put it into the stock market. I think the stock market, I know it's been on a roll, but it is still basically priced, I think, for a double-dip recession. PE ratios on forward earnings are very low. And if you think that this economy muddles through and then maybe moves up a gear next year, maybe we get 4% growth next year as opposed to 2% or 3%, in that kind of environment, I think stocks look pretty cheap here.
Hey, David, it's Sheila Dharmarajan here. So you think that the markets look cheap, but what's it going to take to get the mom-and-pop investor back in? Because clearly money has just been flowing out of the market. You can't convince the average investor out there that things are looking cheap right now.
Absolutely, and the sad thing is that mom-and-pop investors tend to get in very late here. What we've seen in our research is that a lot of it does have to do with consumer confidence. If people feel that the economy is actually beginning to get better, I think they tend to be willing to pay up for stocks. So, and consumer confidence itself is related a lot to the unemployment rate. So if there was one thing that will make more of a difference than anything else, it's, can we get the unemployment rate to come down a bit? I don't see that right now, and unfortunately that means that institutional investors, hedge funds and professionals will tend to be able to take advantage of this market increase before the average individual investor gets in.
Okay. All right, David, we're going to have to leave it there.